Welcome, guys. This is the first time we've had a webinar this year. I hope everybody had an enjoyable holiday. I don't know if you guys have been paying attention to the market, but it's kind of been a little bit interesting this year, I will say. So in any case, let's go ahead and get underway. Let's read the legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock, the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. And MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. I guess I got a little bit rusty over the break. In any case, welcome. We had a huge amount of signups today. I really appreciate your signing up and coming, and we have a great class today. Chuck Hughes is just won his 8th World Championship. I think he said, and he can clarify me if I say anything that's wrong, but it's the most that anybody's won the competition in the history of the competition. So great speaker. Have the pleasure of working with him to help put his methodologies in MetaStock. I'm going to show you that for a few minutes at the end of it. And let's go ahead and kind of get, like I say, I'm going to get out of the way and let him speak. Charles, I can hear you.
Okay, good. Can you hear me, Jeff?
I can hear you. You sound great. I'm going to go ahead and give you control right now.
Okay.
Is there anything you'd like to add?
No. Like you say, the markets have been very interesting so far this year, but I'm going to show you a strategy that's been working.
All right. Great. It's all yours. The floor is yours. I can see your screen, and I think you just need to start the slideshow.
Okay, there we go. Can you see it okay?
Perfect.
Okay, great. Well, thanks, Jeff, for putting this together and your introduction. It's great to be here today. And today I wanted to talk about Prime Trade Select, which is our process we go through when we're selecting trades. And I've been using Prime Trade Select for many, many years. And I'm going to show you some current trades that we have on right now and how the strategy works. And also the second half of the presentation is how we protect our profits when we're trading either stocks or options, and I'll show you how to do that. That's an important part of the process, and obviously this year so far that we're glad we have all that protection in place, and we're profiting even though the market's going down. So as Jeff mentioned, there's a MetaStock module available for Prime Trade Select that will automatically screen through lists of stocks and pick out the stocks or ETFs that qualify as a trade. And then I'd be glad to have a Q&A session at the end. Just a little bit of an introduction to the Hughes Optioneering team. I'm going to show you at the end there that we have $2.6 million in profits the last 2 years. We have $853,000 in open trade profits and $1.8 million in closed trade profits, and I'll show you those brokerage statements at the end. We have over 60 years of combined trading experience, and we started teaching our option strategies to other traders 21 years ago. I started out my option trading career with a $4,600 trading account, but within my first 2 years, my tax returns show that I made $460,000 in profits those first 2 years, which is more than I had made the previous 6 years as an airline pilot. Here's a copy of those first 2 years of option trading and my Schedule D showing the $460,000 in profits those first 2 years. And the Optioneering team has received a total of 13 World Trading Championship trophies, including 8 first place, 4 second place, and a third place. And I've actually won the trading contest 8 times, which is more than any other trader. The World Cup Trading Championship, that's a real money contest, and results are audited before being posted on the sponsor's website. So the contest just ended December 31st, 2 weeks ago or so, and I took another first place with a 309% real-time return last year, and the year before I came in second with a 339% real-time return. So I'm not showing you these results to brag, but we just want you to build your confidence in the optioneering strategies, and we just want you to know that you're learning from somebody that knows what they're talking about. Okay, Prime Trade Select. Part 1 is our trade selection process, and there's 3 steps in part 1. Step 1 is we want to determine the price trend of a stock using the 50 and 100-day EMA system. Step 2 is to select a low-risk entry point using the Keltner channels, and I'll show you how we do that. And then step 3 is use what I call the 1% rule to select an option strike price with a high probability of success. And this is an important part of the process, is selecting that option strike price if you're going to trade options. Of course, Prime Trade Select works for trading stocks and ETFs as well without trading any options. So it works well in just about any market that you want to trade. And then part 2 is really our trade management system. Once we enter a trade, then our 3 trade management rules take effect, and we use a 30% rule for walking away from the trade. We use the 30% rule for protecting profits, and then we also, rule 3 is we roll over the option at expiration if the stock is still on a Prime Trade Select buy signal and the trade is profitable. So let's just look at the risks you face when you're trading options. And options are leveraged, so they provide more profit potential, but compared to stock investing, but the leverage, of course, also incurs more risk. And this is a snapshot of a Home Depot option chain, and back then Home Depot was trading at 77.73. The stock was trading at 77.73. So if we were going to buy the at-the-money call, which in this example expired in 67 days, if we bought the at-the-money 77.5 call, we'd pay 320 bid price, 330 ask. So we'd probably be able to buy this for 325 or 330 if we were going to purchase the at-the-money call option at that time. So let's take a look at the risk profile for purchasing that at-the-money call, and we've developed 6 option calculators that will calculate the profit potential for an option trade before you take the trade. So what I'm showing you now is our call option purchase calculator, and it'll calculate the profit potential for buying that at the money 77.5 strike call option at 325 when the stock was trading at 77.73, and it'll calculate the profit potential for this trade assuming various price changes in Home Depot stock at option expiration, in this example from a 10% increase in the stock to a 20% decrease. So this top row here is the change in the stock price, and the bottom row is the percent return, and the second from the bottom is the dollar return. So we can see that if we purchase this option and the stock is flat, it's trading at 77.73 at option expiration, we're going to lose 92% on this option, and if it's down at all, we're going to lose 100%. And if the stock is up 5%, we'll make 26%. So you can see if the stock doesn't move in that time period and it's flat or even down, then you're going to lose, you're going to sustain a big loss. So our goal is not to sustain any kind of those big losses like you see here for an at-the-money call, and I'll show you how we do that. So this, in general, option trades can easily result in 100% loss of the option premium. So the goal of Prime Trade Select and our money management is to avoid these large losses which can knock you out of the game. You only need a few of those 100% losing trades and you could be wiped out, you know, especially if you took a long position in options in December, you could already be, you know, down almost 100% on those options. So let's take a look at in general the timing risk that you face when you're trading options. And what I have here is the daily price movement of the VIX index. Of course, that's the fear index, and every one of these up spikes is a market sell-off. So you can see, you know, there's been a lot of market sell-offs. It's even higher today. This was taken yesterday, but you can see every one of these market sell-offs. If you were long a call option, that could easily result in 100% loss. So we don't want to take that risk when we're trading options, and I'll show you how you can do that. And again, here's the daily price movement of the VIX. And what we do with our trade selection is we select a low-risk entry point to avoid being stopped out of the trade, and then we use that 1% rule to select the option strike price, and then the 30% rule for walking away, and then we have the 30% protect our profits rule. So if you put all these into place, you can be successful even this month when the market's been way oversold. We're still profitable using these rules here. So let's take a look at step one of our trade selection, and that's determining the price trend of a stock. And we use exponential moving averages to do that. And of course, when you use a trading system, trend following system, the goal is to quantitatively measure the buying selling pressure of a stock, and what that does is it allows us to follow the price trend instead of trying to predict the trend. So we like to use a trend following system instead of making emotional decisions, and we've been using trend following successfully for 30 years. And this trend following Prime Trade Select worked well in the 2008 and 2008 bear markets when the system told us to go short. So we were heavily short during those bear markets and did well despite the bear markets. And we used Prime Trade Select to select the short positions that we had back then. Okay, very simple system. If the 50-day exponential moving average is above the 100-day exponential moving average, then that stock is on a buy signal, and if the 50-day EMA is below the 100-day EMA, that stock is on a sell signal. And if a stock is on a buy signal, then we want to either purchase the stock or a call option on the stock. And if the stock is on a sell signal, you can buy a put option or you can purchase an inverse ETF. That's another way of going short the market without unlimited risk. So you can either buy an inverse ETF if you want to just limit yourself to purchasing an ETF, or you can buy a put option on that stock or ETF, and of course the inverse ETF or the put option will increase in value as that stock goes down in price. So it's pretty easy to establish these short positions without taking a lot of risk, and we're actually starting to enter short positions right now. So I'll show you some ETFs that I think are prime right now to take short positions. So trend following works in both bull and bear markets, and we've done well in bear markets. So let's look at an actual trade that we took using the EMA system This is for Cigna, the health insurer, and you can see that this was back in September. That blue line there is the 50-day EMA. So right there, that blue line crossed above the red line. So once the 50-day EMA was above the 100-day, then that stock was on a buy signal. And as long as the 50-day is above the 100-day EMA, then that stock is on a buy signal. Here's an example of a sell signal, and this is for the China ETF, and we can see that just recently the blue line, the 50-day EMA right here, crossed below the 100-day EMA. I believe that was in July. We don't have the date down there, but I believe that was in July. And once that 50-day crossed below the 100-day, then that China ETF was on a sell signal. So at that point, you could either buy the China inverse ETF, or you could buy a put option based on this sell signal for the China ETF. So right now, the ETFs that we're shorting are the energy ETFs, basic materials, the industrials, China, and small cap stocks. These small cap stocks have a lot of those oil companies in there, and you know, they're saying now that a third of all oil companies are going to go out of business. So you know, you definitely want to be short a market like that. However, these markets are getting very oversold, so I wouldn't take a short position yet. I'd wait till the markets rally a little bit and then take a short position. But these are the sectors that we're looking at to take short positions and have taken short positions. Okay, step 2 in our trade selection process is we want to select a low-risk entry point using the Keltner channels. And the Keltner channels are kind of like the Bollinger Bands. They're overbought, oversold indicators, and we use those to help us time our trade entry and exit points. And they also provide high probability buy and sell signals, and they can also be used to help options select option strike prices. And so that's a very, very useful tool for timing your entry. So first we determine the price trend, and then if the stock is in a price uptrend with the 50-day above the 100-day EMA, then we'll start to watch that stock and then wait for it to retrace a little bit before we enter. And we use the Keltner channels to do that. This is a daily price chart of Home Depot, and you can see this is the daily price movement, these red and black vertical lines, and then overlaid are the Keltner channels. There's 3 channels. This upper blue line is the upper channel, the dotted line is the middle channel, and the lower blue line here is the lower channel. So the idea is when the stock is trading up near this upper channel or above the upper channel, then the stock is becoming overbought, and we don't want to buy at that point. We want to wait till it retraces before we take a position. So usually when it gets overbought, it retraces, and then when it gets oversold and it's trading down near the middle or lower channel, then it's getting oversold, and that's when you want to time your entry. So you can see this pattern here: overbought, retraces, overbought, retraces, overbought, retraces, overbought, retraces, overbought, retraces. So you can see that pattern when the stock tends to get overbought, it retraces, but then you can also see when it gets down near that lower channel and it's getting oversold, it rallies, oversold, rallies, oversold, rallies, oversold, rallies. So this is a very useful tool for helping us time our entry price. Here's a couple trades that I have on now. This is for Amazon, and this is the daily price chart for Amazon. And right back in here, when it retraced towards the middle channel here, you can see there wasn't much of a retracement. This last year in 2015, it really didn't retrace anywhere near that lower channel. So I had to wait till it retraced towards the middle channel, and then I bought the January 330 strike call option. This is my brokerage account transaction history. So you can see I bought the January 330 strike call option at 113. So you can see that that did get me a good entry price into Amazon because the stock didn't really retrace from my entry price. So I waited till it retraced to the middle channel, made my entry, and then the stock rallied after that, and the Keltner channels enabled me to get a good entry point. Very similar chart to Netflix, and I bought right in here when it retraced to the middle channel, and that was right before Netflix had their stock 7-for-1 stock split. So I bought the 500 strike call at 174.50. Of course, after the stock split, the 500 strike call became the 71.43 call. So I was able, again, you can see I was able to get a good entry right here because the stock didn't really retrace from my entry point. So here's one more example for Starbucks. And, very strong uptrend. It's just coming down, hitting that middle channel here, and you can see that Starbucks, like Amazon and Netflix, very strong uptrend, and you want to participate in that. But the question is, where do you jump in? So we use these Keltner channels to help time our entry, and we can see there was very little retracement after we bought the Starbucks 40 strike call at 1375. So in these examples, the Keltner channels resulted in low risk entries as for the option trades, as the stocks did not retrace much from our entry point. So this helps prevent getting stopped out of our position and helps our timing on when to enter a position. So step 3 in the selection process is we use what we call the 1% rule to select an option strike price with a high probability of success. So once you decide that you're going to trade an option, you could have hundreds or even thousands of strike prices to choose from. So selecting the strike price of the option is just as important as the trade selection itself. And we use a very simple rule I'll show you here for selecting that option strike price. And we know with option basics that option premiums consist of time value and intrinsic value, and options lose all time value at option expiration. So when you buy an option, you're buying a decaying asset. So you always want to keep that in mind, that time value is going to decay a little bit each day until you get to expiration, then it goes to zero. So whenever you buy an option, you're buying a decaying asset. You always want to keep that in mind. So due to those time decay characteristics, when we buy an option, we want to minimize the time value because that's going to decay to zero, and we want to maximize the intrinsic value. So we have a simple rule, and what we do is we limit the time value portion of an option to less than 1% of the stock price per month to minimize the time value and maximize the intrinsic value. So for example, let's say a stock is trading at 100 and we buy a 1-month option. So we want to limit the time value portion of that option to less than 1% of 100, which would be 1 point. So we want to limit the time value to 1 point. And if the stock's trading at 100 and we buy a 2-month option, then we want to limit the time value to 2 points. And if you limit the time value portion of an option to 1% of the stock price, the stock only needs to increase 1% in order for that trade to break even and start making money. So if you use this 1% rule, your trade is going to have a much higher probability of being profitable than buying an option strike that requires, let's say, a 6 to 10% increase in the price of the stock just to break even, because a lot of times you're not going to get that 6 to 10% increase that you thought you would, and that could result in a 100% loss. So let's look at a out of the money call purchase first. Now, we don't trade out of the money options, so I don't have any actual examples, but I just took a snapshot from Yahoo Finance, and this was for Priceline, just to show you an example of an out-of-the-money call purchase. So at the time, Priceline stock was trading at 11.62, and we were going to buy, this was about a 1-month option, and we were going to buy, we'll just assume we were going to buy the 12.70 strike call, which was trading 11.50 by 12.60. So with the stock trading at 11.62, the 12.70 strike call trading around 12 bucks, let's calculate the what the stock has to do before we break even. So if you add the premium, in this case 12.60, to the strike price of 12.70, we come up with a break-even price of 12.82. So remember, the stock was trading at 11.62. So the stock has to go up 120 points, which equates to a 10.3% move, or this option would result in 100% loss. So you don't want to put yourself in a position like that where you can lose 100% if the stock doesn't go up 10%, because a lot of times it's not going to go up 10%. So here's the call option calculator. Again, you can see if in this particular example with the stock trading, Priceline trading 11.62, you buy the 12.70 strike call at 12.60. If the stock is flat, you lose 100%. If the stock goes up 5%, you lose 100%. And of course, if the stock goes down at all at expiration, then you lose 100%. So you don't want to put yourself in that position. Even if it goes up 10%, you're going to lose 31% on this option. So you don't ever want to be in that position. So let's look at an example of selecting a strike price using the 1% rule. And we're going to look at this Starbucks 40 strike call, and we paid $13.75 for it. So the day we bought this, Starbucks stock was trading at 53.63. So with the strike price of 40, that's below the stock price. So this was an in-the-money strike price. And let's look at the risk profile. So the stock trading at 53.63. If you subtract the strike price of 40, you come up with an intrinsic value of 13.63 for this option. And we paid 13.75, so if you subtract the intrinsic value, you get the time value of this option is only 12 cents. So if the time value is only 12 cents, then the stock, Starbucks stock, it only has to go up 12 cents and we start making money on the option. So I'd much rather be in that position than having to depend on a stock going up 10%, or otherwise I lose 100% of my money. So here's the call option calculation for this call option purchase. Starbucks trading at 53.63. We bought the 40 strike call at 13.75, and we can see that the call option calculator will also calculate the time value and intrinsic value. So again, the time value is 12 cents and intrinsic value is 13.63, so it's almost all intrinsic value, and Starbucks only has to go up 12 cents, and we start to make money with this option. So with Starbucks trading at 59, this option had a 38% return. So you can see, even though we're buying in the money call that costs more in terms of the premium than an at the money or an out of the money call, if the stock goes up 10%, we're going to make 38%. If it goes up 20%, we're going to make 77%. So with these in the money calls, your percent return isn't as high, but that's still a pretty good return. If the stock goes up 10 or 20%, I can live with that. So what this is a trade-off. You're buying in the money calls, which have a lower percent return, However, your odds of getting stopped out are much lower than if you buy an at-the-money or out-of-the-money call that requires the stock to go up, say 5 or 10%, or you lose 100% of your premium. So this is a better way to trade options, and it's an important part of our trade selection. So again, in that example we just looked at, Starbucks stock only has to go up 12 cents, or 0.2% for the trade to break even and start making money. So that's how we select strike prices. So Prime Trade Select has produced a lot of winning option trades, and so let's look at our trade management rules. Once we enter the trade, we use a 30% stop loss rule for walking away, and we use a 30% rule for protecting profits, and then we roll over at expiration if the stock is still on a buy signal. Let's look at the 30% rule for walking away, and that's just a simple stop loss rule. So if the price of the option drops 20% below the price you entered, then you want to start looking to exit, and you want to be out before it hits 30% loss. So this can help prevent a 100% loss on the option. And the only way we can use this rule is if we buy in the money options, because if you buy at the money or out of the money, you know, you could have 100% loss in just a few days with at the money or out of the money calls. So you really can't use this money management rule. But if you buy in the money calls, you can use this, and you can get out before you have a major loss. So here's an example. We bought the J&J 80 strike call at 23.72. So we'll watch this on a daily basis. You don't have to watch the market closely or anything, but once a day we'll look at it. And if it, in this case, if it drops 20% to about 19, if that option there drops to 19, which is about a 20% loss, then we start looking to get out, and we want to exit before it drops 30%. In this case, to about 16.50 on a closing basis. So if you use the stop loss, it helps prevent a total loss of the option premium. And then we have a rule for protecting profits. And anytime we purchase a call option, if it has a 30% profit, then we create an option spread to provide downside protection and to protect those profits. So this, when we use this rule, allows us to hold on to winning trades during sell-offs like we're having right now. So option spreads have a long position and a short position, and the long position, of course, profits as the underlying stock or ETF moves up, and the short position profits if the underlying stock or ETF moves down. And it's possible for these spreads to profit if the underlying stock increases in price, remains flat, or declines in price, and I'll show you some examples of that. And it's also possible for you to lock in and guarantee yourself a profit when you create this spread. So it can allow you to guarantee your profit on your call option purchase if you create this spread. And we call these market neutral spreads, and a market neutral spread is created by buying a call option and buying a put option. And this can be done simultaneously, or you can buy the call option, and if you have a profit in it, you can leg into the market neutral spread at a later date by buying a put option. And that's what we do mostly. We'll buy a call option. If we get a profit, then we'll lock in that profit by buying a put. And of course, the call option profits if the price of the stock goes up, and the put option profits as the price of the stock goes down. And of course, your risk is limited to the cost of the spread, and there's no limit on the profit potential of the spread if the underlying stock continues to increase in price. So it allows us to hold profitable trades during market sell-offs, and also to lock in profits. And here's some examples. We purchased Amazon, Google, Facebook, Netflix, Starbucks, and the healthcare call options. And we had a profit in the call option, so what we did at a later date is we purchased a put option, and that allows us to protect the profits, and in most cases I'm going to show you actually lock in a profit so you're guaranteed a profit. So these are brokerage transaction histories here, and you can see we bought the Amazon January 515 put, bought the Google March 670 put, Facebook. So we had profits in these options, and we also own the stock on these. And you can also use this market neutral strategy. If you only buy stocks and you want to lock in a profit on your stock, you can also buy a put option. So these work for both stock purchases and call option purchases. So we bought these put options to protect our position. So let's look at a recent example. This is for Home Depot. Home Depot was on a prime trade select buy. We used the 1% rule for selecting the strike price, and then the trade was profitable, so we used the 30% rule for locking in our profits. And this is a portfolio profit loss report, and when I took the snapshot, you can see we bought the Home Depot 80 strike call at 10.15. So we had a pretty big profit in this, $120,000 profit. We had 45 contracts. So we don't want to we don't want to risk that much profit. So what we did is we bought a put option to protect that, and we usually buy put options that are 2 to 3 months out, and what we'll do is we'll roll over. When that put option expires, we'll buy another one. So this is an example of a put option that we bought. We bought the 110 strike put option, and that created a market neutral spread. So we bought 45 of the 110 strike puts at 420, and that created a market neutral spread. And when that option expired, we bought another one, so we just roll over these puts as we go along. So you can see this portfolio profit loss report. We bought 45 of the 80 strike calls at 10.15, and we bought 45 of the 110 strike puts at 420. So let's look at the risk profile for this trade, and we have an option calculator for these market neutral trades. And like the call option calculator, this will calculate the profit potential before you take the trade, and the profit potential will be based on various assumptions in a change in the, in this case, Home Depot stock at option expiration. In this example, from a 30% increase to a 100% decrease in the stock to 0. So we don't anticipate that, of course, buying a blue chip stock, but I just wanted to show you this risk profile. So this calculator will calculate this profit potential. At the time, Home Depot stock was trading at 115.17. We bought the 80 strike call at 10.15, and then at a later date, actually this was a rollover, we closed out of the expiring put option, and then we bought the 110 strike put at 420. So we can see with the call option calculator that if Home Depot stock is flat at option expiration at 115.17, then the spread profit will be $2,082, and the percent return will be 145%. So we can see in this case, by buying that that 110 strike put at 420, we actually locked in a profit, and our minimum return in this example would be 145%. But look what happens if the stock goes up. Your profits keep increasing. So if a 10% move in the stock, you'd have a $3,234 profit, 225% return. So these don't limit your profit potential if the stock continues to go up. So your profits with the spread continue to go up. But look what happens if the stock goes down. Now, I wouldn't expect Home Depot stock to go down 40% or 80 or 100%, but you can see that even if the stock goes down, your profits start to increase as that stock goes down. So in this case, we locked in a minimum profit of 145%. So no matter what happens in the market, we're going to make 145% with that trade. Here's another example. This is for the healthcare ETF, the symbol XLV, and we bought 64 of the XLV January 50 strike calls at 960. So we had a profit in that. We wanted to lock in that profit, so then we bought the 75 strike put at $4. So again, this we rolled out of the previous put that expired, and we bought the January 75 strike put at $4. So in this case, that really helped us during this sell-off, because the XLV is way below 75. So let's look at the profits that we locked in on this trade. So again, we bought 64 of the January 50 strike calls at 960, and we bought 64 of the January 75 puts at $4. And this calculation shows that if the XLV is flat at 71 at option expiration, which is in 2 days, then we'll realize a minimum profit of $1,140 per spread, or 83% in this case. And then if XLV went up in price, which it did not, then we would make money, and there's no limit on the profit potential if the XLV continues to increase in price. And then if it goes down in price, of course, then our profit potential starts to increase. So this enabled us during this current market sell-off to really protect those profits, because XLV has been very weak, and I think it's trading around 66 or 67 right now. So you can see no matter what happens, we locked in this 83% return. So this is a very low stress way to trade options when you don't have to worry about anything and you're guaranteed a profit. So let's look at this is an actual portfolio of market neutral trades, and what I did is I took a snapshot of the market neutral trades. This is for Cigna, Costco, J&J, Starbucks, Wells Fargo, and Yahoo, and I took a snapshot of the profit loss for these various trades, and we can see in this column it lists the dollar profit or loss, and in this column it lists the percent profit or loss. So what I did was I took each one of these market neutral spreads and put them into the calculator just to see what the potential return is for this portfolio of market neutral trades. And what we came up with was if these stocks rally on average 10%, then this portfolio as a whole will have a 711% return. So you can see that this portfolio is combined into one portfolio. In other words, we combined all these trades into one portfolio, and if the average stock, if the stock in this portfolio goes up an average of 10%, we'll have a 711% return. So that's a great return. But what happens if the stocks in the portfolio go down? Let's say that we're going through a sell-off like we are going through right now. So this is where it gets really interesting. If the stocks go down on average 20%, this will have a 1,200% return. And if the stocks remain flat, we'll have a 277% return. So the minimum return for this portfolio is 277%. And if you can see if the stocks on average go down, we'll have a big return. and if the average stock goes up, we'll have a big return. So this is a pretty low risk way to trade. So we know as traders that you don't want to be sitting on a portfolio of winning trades only to see the market turn and those winning trades turn into losing trades. That's the worst feeling when you're trading and you have a profit and you're feeling good about it, and all of a sudden there's a unexpected market decline and then those profitable trades turn into losses. So we avoid that by purchasing these put options. So this is a great way to trade. These unexpected sell-offs can and do happen, and so far this year it's happened. So we like to protect our options whenever we purchase them and we have a profit, and we don't have to worry about bad earnings reports or disappointing unemployment reports or spikes in energy prices or drops in energy prices or geopolitical tension. So we simply put on our trade, our market neutral trade, and then we can forget about it until option expiration. So a very low risk way and low stress way to trade options. And there's no need to monitor the markets when you have these market neutral trades on, and severe sell-offs in the market can result in windfall profits like you saw. So in this case, we're getting into some of our current market neutral trades. We're starting to get into those windfall profits because the stocks are down so much, and your profits start to increase the more the stock goes down. So it's a great way to trade. Here's a snapshot of these market neutral trades. These were in my retirement account actually, and this shows the trades here. This is for Apple, Facebook, Google, QQQ, and this portfolio had a $70,000 open trade profit when I took the snapshot. And this retirement account, my bigger retirement account, had 199,000 open trade profit. And the nice thing about this is, even if these stocks all decline precipitously, I would still show a profit in these portfolios because of the market neutral strategy. In our last trade management rules, we want to roll over option profits to reduce risk and compound our returns. So once we're approaching option expiration like we are now, January expires in a couple days, and we're already starting to roll these over. The trades that are still, if the stock is still in a buy signal, then we're starting to roll these over into March or April, and we'll go a couple months out and establish another market neutral trade, and that way we can roll our profits into our new trade. And in this case, this is a rollover for XLV, and we closed out 36 calls with a $31,000 profit, and then we rolled into the September, and you can see the September cost $56,000. We had a profit of 31, so now that reduces our cost basis to 25,000. So our cost basis for the new option in this rollover was reduced by 50%, and of course that reduces your risk and your exposure. So we like to roll things over. So let's just look real quickly. These are actual profits. These are closed out trades, and this is over a 2-year period from January 2014 to January 2016, and this account had a $752,000 long-term gain and a $1,087,000 short-term gain. So this portfolio report, what this will do is it'll list all the trades that I took during that 2-year period. There's too many here to show you tonight, but the net result of that was $1.8 million in closed trade profits over those past 2 years. And this is an open trade snapshot. This was a couple weeks ago before the big drop. This shows our positions here and our spreads in the account. And this account had a $716,000 open trade profit. The profits are listed in this column, and then the percent return in this column. And this is a continuation of the positions and the spreads that we had. And at the time, we had a $716,000 open trade profit. In the second account, we had $137,000 open trade profit. So all in all, we're faring very well during this market sell-off because we had these put option protection in place, and we had these market neutral trades that allows us to profit no matter what happens. So we have an advisory service, and we make trade recommendations. We send out emails whenever we have a trade recommendation. So we have various portfolios here, covered calls, option purchase, option spreads, market neutral spreads. So if you're interested in the advisory service, then you can log on to weeklyoptionalert.com and then click trade results, and it will give you updated trade results for these various strategies, so you can get an idea of how they're performing. And if you're interested, you can call Brad toll-free at this 866-661-5664, or his direct landline at 310-647-5664. So if you're interested, give Brad a call. We'd be glad to sign you up for the option advisory service. So that concludes my presentation. I'd be glad to take any questions at this time.
Can you see him, Chuck, or should I just read some to you?
Yeah, let me see. Yes, I can see them. I'm going to try to expand this a little bit so I can see more. Oh yeah, okay, I can see them now. Okay, here's a question. The 1% rule sounds great. Drawback is having to purchase either ATM or ITM options, which are obviously more expensive. This can be tougher with smaller accounts. Do you advocate buying spreads at that point on higher price stocks? And I would just say in general that if you're going to trade options, I would use this 1% rule no matter what. And if you don't have enough money in your account to use that 1% rule and buy the in-the-money options, then I wouldn't trade. So it's that important. So if in small accounts, I would only trade options if I could use that 1% rule to select the strike price. Otherwise, you have a tremendous amount of risk, and you don't want to do that when you're trading options. So I would use the 1% rule, and if you don't have enough funds, then I wouldn't trade. Okay, is the option calculator standalone product? That's a good question. The calculators, we have 6 calculators that will calculate the profit potential for these option trades and different strategies before you take the trade, and they're available to all the members of the advisory service. So it's a handy tool to have. All right, let's see. See if there's any more questions here. Okay. Is today's webinar being recorded? Yes, we recorded the webinar, so you can look at it at a later time. Here's a question about books and courses, and yes, we do have books and courses available, and we have a MetaStock module that will pick out these trades for you using Prime Trade Select. So I'll let Jeff talk about that here in a minute, and I think that's it on the questions.
Well, great. Trey asked a question if you're entering for the 2016 World Cup contest, and I'm pretty sure the answer is going to be yes for that one.
Yes, I've been so busy with the market the way it is that I have not signed up yet, but I will once I get some time and I can come up for air. Yeah, I'll give it another shot. It's a lot of fun to compete in the contest and try to demonstrate, that your strategies are still valid and still working.
Do you use implied volatility?
I don't know what that is, so I guess I don't use it.
Okay, that's a question that came up a couple times, so I figured I'd ask.
Yeah, yeah. When it comes to trading options, my uh, strategy and philosophy is pretty simple. If the stock is in a price uptrend, you want to buy a call option, and if the stock is in a price downtrend, you want to buy a put option, and that's all I look at. And I don't look at Greeks or anything like that because that's way too complicated. And you saw those option calculators. You can see that the profit for an option trade depends solely on the price movement of the underlying stock. So, uh, the option is going to lose all time value at option expiration, and you can see that the profits are totally dependent on the stock price movement. So we like to just follow the stock price rather than get into all those other complicated strategies. So for us, simple is better, and we want to buy a call option if the stock's going up and buy a put option if the stock's going down.
Great. James asked a question that I'm going to answer for you.
Okay.
I'm
Okay.
looking for systems that allow me to piggyback successful trades automatically on my account. Do you offer any type of automated trading?
No, I don't.
But
I'm
I would
not.
I would say
I'm
that
not.
the inner circle is designed to kind of give you those ideas, and placing the trades themselves is probably not going to be that difficult.
No, no. We send out emails every time we enter a new trade or exit a trade, and they have specific instructions on what strike price to buy, etc. So you get very specific instructions. It only takes a minute to either put that order in online or hand it to your broker. But to answer your question, I can't recommend brokers, but we do have brokers that will auto trade the advisory service, but we can't give out any recommendations. But we know there are brokers that will auto trade it.
Do you have a recommended minimum account size? Is a question that's coming in.
Yeah, that's a good question. I would think that with $5,000 you could buy 3 or 4 or 5 options and in different industries and be somewhat diversified. I would think if you just want to trade options, you just want to buy call options or buy put options, you could start out with a $5,000 account.
Okay, great. Okay, perfect. Gerald asks, what's an ETF? Do you want to take a stab at that one, or should I?
Oh yeah, yeah. Gerald, an ETF is an exchange traded fund, and I showed you a price graph for the China ETF, and what that ETF has in it are Chinese stocks. And so when you buy an ETF, you're buying a basket of stocks. And ETFs also cover commodities. So if you buy the oil ETF, you're buying oil. So ETFs are a great way to play a sector. So if the tech sector is going up, you can buy the QQQ, which is a basket of tech stocks. You could buy a call option. If Chinese stocks are going down, you can buy the Chinese ETF symbol FXI. You can buy a put option on that, and you're buying a basket of stocks with that ETF, that China ETF.
Cool. Very good. Yeah, an ETF, QQQ, SPY, DIA, Gerald, those are all ETFs. All right. Okay. Chuck, great job today. Actually, really appreciate the presentation. Um, and I'm going to go ahead and take over and just show you.
Okay, that sounds good, Jeff. Thanks for putting this together, and I want everybody to have a happy and prosperous new year.
Thank you. Yeah, great webinar. I say it all the time, but I really enjoy the fact that we can kind of, my job is literally to work with world champion traders, and it's so
Okay.
good to be able to sit down and kind of learn from people from Chuck Hughes. And I say it all the time. Some of the methods that I find work really well are the ones that are very understandable, and I mean, you just can't argue. So I would recommend the Inner Circle service and taking a look at the monthly advisory service. And congratulations on that win this year as well.
Oh, thank you. Thank you. I appreciate that.
I do want to spend just a couple minutes to show you kind of the work we did a few years ago with Mr. Hughes in putting together kind of his package for MetaStock, because one of the things I love about MetaStock is its ability to scan for and find these types of opportunities in some sort of an automated way. It's really, really easy to use. And I'm just going to kind of show you a scan of ETFs that I ran today and kind of show you how that works within the software. It's pretty easy to run, really. What we can kind of come in here and do is I can click on my scan tab. And basically, we call it the Explorer in MetaStock. I can come down here, and I'm just going to find Hughes on my list. I've got a huge amount of scans that we've developed over the years, but I can just find Chuck Hughes, the basic scan. And I go ahead and select that. Leave all this stuff over to the side the way it's set. You don't have to change that at all. And what you're going to do is you're going to come down. Actually, I do want this set to daily, but I ran it earlier on a daily basis. And what you're going to do is you literally can select what you want to scan. So if you like the strategy, obviously you're probably interested in options. We can easily go ahead and scan through all of the optionable stocks that are in the universe. If you want to include ETFs, you can just kind of go ahead and click on that. That's going to scan through the ETFs for you. If you like the strategy but you're overseas, for example, we get a lot of customers in a lot of different markets. We do have those markets that are available, whether it's Australia or India or whatever you might want to, whatever the interest might be. But it is just a matter of kind of selecting the options that you want. I ran it against the ETFs this afternoon after the market closed, and it only took like about a minute or so to come back with just the ones that have a high probability buy signal. So I'm going to show you that report instead of actually just running it. We'll just show you kind of what the report looks like. Out of the 1,300 stocks that I scanned, oh good, it's right here. Let's see if we can pull it over real quick. Only 6 of them had a buy signal, so already you're going to be saving a lot of time just by being able to see out of the ETFs that I'm interested in, these are the ones that actually have a buy signal that generated today. And so basically what I did is I saved this to a list. I called it Chuck Hughes. There's 6 of them. And then you can kind of come in here. And when you open up the chart, we'll go back to the charting tab right here. Here's those 6. Basically just open up the first one, open it up with our template that applies like all of the indicators that you want to use with it, as well as the expert advisor. And kind of the results are going to be, let's go back into MetaStock, kind of like this. This is probably what you're going to see. And basically, it's going to give you the rules for the strategy. Anytime it's in the blue, it means it's kind of set. If it's high, it's come back to the Keltner channel, either the middle band or the lower band, and it's a good opportunity to buy. You've got your rules right here so you can kind of remember why we're finding the stock, and then all of the suggested exit guidelines. So it's been a very, very successful product. People really, really like it. And obviously we have 6. We're only going to look at 6 securities. We can then decide on the ones that we like. Got a little bit. Okay. Basically, that's really kind of how it works. It's a very simple product, and just designed to kind of help you piggyback on, well, somebody that's won the World Trading Competition 8 times in a row, so it's pretty cool that way. Normally we retail this thing for ridiculously cheap. I think we should charge more for it, but it's $4.99. It's $3.99 here at the MetaStock, the webinar today, and it does come with a 30-day money-back guarantee. If you need MetaStock, it does require MetaStock to run. We will throw in a license for MetaStock on a trial for you for a month to evaluate, and I'd encourage you to try it out. It's like I said, it's been very, very popular. Obviously, we're piggybacking on great traders here. So give us a call. The phone number for that is 800-242-9901. And we actually do have people online right now, and you can chat with them at metastock.com/sales chat. With that being said, really appreciate you guys coming here. Going to go ahead and close down the webinar room. If you have additional questions, feel free to drop me a message. And I really appreciate your coming tonight, and we'll see you at the next webinar. Well, there are a few questions I will answer. I noticed quite a few piling in it. What do you call an inverse ETF? That's what you call it, an inverse ETF. Trey says, does it work with RT or end of day version of MetaStock? Either version will work. Another question that came through is this for an annual subscription? It's a one-time cost. You own it. Trey, you're welcome. Thanks for coming. I really appreciate you showing up today. All right, and that's it. I'll see you guys at the next one.